Hey everybody, welcome to another free edition of our Trader User Group, a weekly roundup. This is for the trading week ending Feb 28, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is clearly fear grips the market. I mean, we saw our indexes here in the US all down in correction territory. The Dow was down over 12%. Year to date, it's down about 11%. The S&P this past week was down 11 point, almost 5%. Year to date, it's down 8.5%. NASDAQ is down over 10.54. Year to date, it's a little bit better. It's only down about 4.5%. The Russell this past week was down 12.04%. Year to date, it's down 13.2%. So what we saw this week was that the S&P entered into a correction territory in only 6 days, which is the fastest in history. And that shows you how algos have really kind of taken the lead in the movement of market price action when there's terms of fear, right? The more that algos move things around, the faster things can move, like a turbocharged roller coaster, I guess. And of course, if we look across the planet here, let me put a screen up here for you. I'm going to get this up here for you real quick. Let's see, what screen is this? This is screen number 4. So let me get this up here and let me just kind of go through a couple of key points and I'll jump right into the chart for you. So it'll take a couple of seconds to come up on the screen. But over the global markets also did the same thing. The FTSE was down over 10%. The CAC 40 or over 11. CAC 40 in France was down almost 12. The DAX was down over 12. The Nikkei was down 9.5%. China was only down 5.2%, but they've been down, very steady for the past month. Hang Seng, the Hong Kong index, was down about 4.3%. And the best performing sector this week still finished down 7.9%. It was communications, and the worst was energy. It was down over 15.4%. What I saw also very interesting was the trailing PE ratio. 12-month PE ratio is at 22.75, but the forward PE ratio, which we're going to see change a lot. I've seen a number of estimates come in. This one from the Wall Street Journal came in at 16.82 now. So the forward guidance, 12 months, is 26% less than the prior 12 months for the price to earnings. And the annual dividend yield, I haven't seen this in a long time. The S&P annual dividend yield is over 2%. 10-year interest rates, I haven't seen this ever, really, down 1.127%. So really an amazing week we had. So if we look at this and we try and put these things together and just draw an analysis, I would not believe anybody if they tell you they know what's going to happen next. They don't. I mean, we can look at the technicals, and what I want to do here is just kind of give you an idea of what the technicals are suggesting, which is all you can do because there's a lot of unknown data floating around out there, and that's what makes this kind of compounds the movement down. So, as the pandemic fears, these fears, it moved from China to South Korea, Japan, Italy, Iran, and, more countries are going to follow. We're starting to see some in Europe. In fact, this morning I heard a couple of new cases reported in California and Oregon here in the U.S. So that's only going to serve to combine the issues and fears of the unknown, right? But if you think about it, this past week, we actually had 2 crashes. One was in the equity markets where it was in a correction territory, and the other crash was in interest rates, which meant bonds just ripped higher. U.S. Treasuries with the longest maturities, which is the 30-year bond, it came in at 1.67%. Amazing. The 10-year note came in at 1.12%. That's considered the risk-free investment globally, 1.12%. Now remember, the Feds have set a goal of at least 10%, or not 10%. They've set a goal of at least 2% for the Treasury in its bid to drive up inflation back into the markets. So good luck with that one. Already this past Friday, Jerome Boom Boom Powell came out and indicated they're standing ready and have the tools necessary to help the markets if needed. But that was such a vague statement. It was really the markets actually after that, it kind of went up maybe one 5-minute bar, and it rolled right back over again. Okay, but the market impact on this coronavirus is really interesting if you just compare it to 2008, right? And the Fed's role in this whole thing and what they can do. The market impact is more of an income revenue impact rather than a balance sheet impact. And what I mean by that is in '08 and '09, it was a financial crisis. The balance sheet seized up. We didn't know if banks were going to be around at the end of the day. Some banks failed, or some investment banks failed. Markets liquidity just seized up. So central banks globally immediately came to the rescue and shored up all these effective balance sheets, pretty much just putting trillions and trillions of dollars of stimulus back into the global economy. Okay. So these types of fixes, balance sheet fixes, can be isolated and applied in a systematic way, like they did in a series of quantitative easing and interest rate reductions. And usually they can bring great results. It takes time, but it just takes the fear out of the market a pretty good bit. Okay. So, and back then the Feds had an interest rate starting point of around 5.1%, somewhere around there. Well, the current rates are hovering around 1.2. So even though they can come out and talk about lowering rates, and there's speculation is already 100%, close to 100% shot that they're going to lower the rates this March. But then there's like about a 60% rate chance that they're going to hike them twice, so a 50 basis point rate cut. That's going to do more for the market psychology and mood than it will do to fix the true issue here. This is more of a revenue issue with the shutting down of production facilities globally. You're going to see that that's going to make it very difficult as this thing works its way through all the various supply chains from China to Japan and Europe. South Korea, same thing. And Europe is going to probably suffer the most. They're close to a recession in some of the countries anyway, like Germany. I think what's probably needed is the global market. Central banks, they need to kind of do a joint policy statement or something. Just say, here's what we're going to do here, while the health professionals work on a pending virus vaccine. But that would, I think, help just tamp down some of the issues here that we've seen this in the fear of the markets with VIX, and we'll get into that in a minute. I mean, Goldman Sachs indicated worst case scenario, even if the S&P reported zero revenue growth for 2020, that still put the PE ratio, around 17, 18 range. So that's, while it's not cheap, it's not expensive either. And they're coming in with a worst case scenario. So the global market, or at least the US market growth, is still intact. But what's added the fear is, the length and the duration of these production facility shutdowns. And we've seen a number of companies have come up so far and talked about it could affect their sectors with revenue reductions from technology, healthcare, travel, consumer goods, and apparels, media, and entertainment. A lot of these have kind of I think there's been 300 companies so far that have already announced their revenue for 2020 is going to be reduced by this. But some of them, like United and a few others, have come out and said, we have no idea what the final impact's going to be, because there may be more closures, there may be more quarantines, and how do you plan that? So the markets, in typical fashion, are going to sell first and ask questions later. Although there is a bright spot in some areas in the tech world. You're seeing companies that offer more stay-at-home type of solutions, like Zoom Video or Netflix or OKTA, more of a business solution, workforce empowerment kind of thing, or Peloton. Any of those seem to have done fairly well, in the thought that people are going to stay home more and probably get one of those kind of things. I mean, that doesn't, to me, make logical sense, but that's just how the markets work right now. And if we looked at the SARS outbreak that happened back in 2002, 2003, it took about 6 months for the markets to recover the 14% move lower in SARS. Now, I will tell you, at the low point on Friday of this week, we were down right at about 15%. So that's pretty much right in line with what happened with SARS. And the reason why it moved down like that is once it escaped the nation state of China and got outside their borders and started moving elsewhere, then that's what caused the rush to the seller's door here. All right. But I'm already seeing that we're starting to get levels where buyers are going to start to step in, and corporate buybacks, which last year represented about 30% of the stock purchases, they set another record this February by buying more stock. And I think with interest rates as cheap as they are, what's to stop them? I mean, it's a great way to raise their earnings per share, take shares and float off the market. So we'll probably see more and more of that. In fact, if you look at some of these stocks now, they're really ripe for the picking. I mean, there was already buyers talking about coming in and picking up Apple, and you're going to see others like Microsoft and Google, which all have very strong balance sheets. you're going to see people come in and pick some of these things up. Okay. Um, so it's one of those things where big money buyers are going to step in and not do it all at once, but they're going to start nibbling, and pretty soon it's going to become a wave. Okay, so let's see how this thing shakes itself out, as we go forward here. Now, looking at the chart I have on the screen, you can see it's a 240 minute Ichimoku. I like the 240 minute because it kind of gives you a inside view of the daily chart. Okay, it sets up a little bit differently on the technical indicators, and you can see here how this fib node right here, and you'll see it's 1 because this was the previous high that this fib node was drawn off of. Okay, in 2018. It's just held up very well, or I mean, it's provided support when we broke. We sat here for over a day before we finally broke above that, um, really going into Friday. Okay, you can see we made a low here. So this low here made on Friday, we're going to watch very closely. It's in the E-minis, it's 28.53.25. So we're going to watch that to see if it's taken out. And I'm going to watch this right here. This is going to be our S1 level right here. See if this will hold going into money. It's hard to predict what Monday is going to bring. I mean, let's see how the news kind of develops the remainder of the day to day, Saturday, and then Sunday. So we'll see how this thing works out. Now, I've told all our members that I would not, if we get a move up like this, I would not be a buyer unless you're a very short term. I'm gonna day trade this, or I'm just gonna swing trade it for 3 or 4 or 5 days, because the odds favor this to move up like this and then come back down and at a minimum test this area here. Generally, when you have a VIX move up into the 30 and 40 range, you're going to have a bounce, right? It's going to be a bounce because you just get so oversold, the market's going to want to move higher. And in that move higher, use that to rebalance your portfolio or shut some trades down or do what you need to do, because it'll probably more than likely roll over. And algos are tuned to some of these key levels right here. So we're going to see something like that. And also, once the VIX gets over 30 into the 40 range, we actually closed on Friday. The VIX closed on Friday at 40.11. It's amazing that we were able to stay above the 40 level, and that's in my red zone. And I'll show you the VIX charts here in just 1 minute. So that just shows there's still a lot of fear of pummeling the markets. And we actually, on this 240-minute chart, had a sell signal, and that was really right in that level there in the support zone. So you could have set a very tight stop right up above it, and then just stay there. And as long as the red's below the blue line here, you could have just been short the whole way down. If you're day trading or you're trading the futures market, that would have been a very fruitful trade for you. Now, also understand that, if you don't understand the Ichimoku and all the nuances with all the various lines on here, I'm not going to educate you on that in this session, this on our weekly roundup. But I'd encourage you to come in and check out our membership, and you can come in here and have fun with it, and it'll really help you out dramatically. So this is what I'm looking at here. We've got an Elliott wave 3 down here. We'll probably get an Elliott wave 4 here, and then a 5 down here, or at least some point in this range right here. Okay. Now, should that happen, the other thing that I'm going to be looking for, and I would expect if we get that kind of move, right? Some people say, oh, heck, we're going to get a V bottom, but I doubt that. There's just too much fear in the market to get that. If we do, this red zone here, this cloud, is going to provide a little bit of support. Maybe we'll come down, find a higher low, and then come back up, and then do one of these numbers and take out that previous pivot high. That would then set up a channel which would give the bulls a lot more confidence that we're going to work our way back up. But the width of this channel is going to be very wide for the time being because volatility is very high. So you're going to see these intraday swings that, for day traders, it could be interesting. But if you're trying to swing trade, if you don't really understand what you're doing and you want to hold a position, I would probably beg against it. Okay. It's just going to be very difficult to do. Okay. Now, if you're holding stocks that you've had for a while, then maybe, you can take the really good stocks. If you had Microsoft or let's say Facebook or Apple, some of those stocks, you could probably, if you have the stock, you could go deep out of the money and just sell a couple of short puts, or you could do a put credit spread to limit the downside risk, and then just take in some premium, because the premium right now is very high. in these markets. So that's a little bit about, what I'm seeing on this chart right here. Now, um, if I come over and show you the MACD, ideally, what I would like to see here to tell me, okay, a bottom is I got a higher probability of saying a bottom is formed, because right now I don't, it's a 50-50 call on whether that's the bottom or not. Okay. The odds and statistics would say it's not. The odds and the statistics would say it's probably going to come up and it's going to come down and test. And then the question is, how much lower will it go? Well, ideally, if we can have the MACD run up like this on this move here, and then have it come down and actually make a lower low, and then it would come down like this, right? And then give us one of these moves like this, where we got a bullish divergence as it starts coming back up again. That would be a good trigger for me. So we would be bouncing off this lower low here, okay? And that basically would mean that selling volume right here on this second leg down was not quite as strong as this leg down here, which was the primary move, okay? So that would be what I would be looking for, okay? So let's just kind of keep that in the back of our mind as we go take a look at a couple of other charts here and just see how things are shaking up. So let me move over to another screen over here. Let's see, what screen is this? That's screen number 5. So let's go look at screen 5. All right, this is another chart, same thing of the E-minis, okay? I'll wait till it paints on the screen here. And you can see in the E-minis, one sign that we're kind of finding a bottom is you can see this green candle here. All right, that's a daily candle. That is a hammer. Generally, when you have a hammer after this kind of sell-off, that tends to mean that we can expect a little bit of a bounce. You can see the low here was at 28.53.25. And if I go back in time just a little bit, you can see this shaded zone here is what started the big rally back in early October. Remember this big rally, and we just blasted higher. A big move, right? All the way up with minor diversions, right? We had a little bit of a bigger one here at the end of January, but it's still relatively minor, about 3% or so. But a pretty good run. And then in literally 6 days, it touched this low that it took, all of October, November, December, and January, going into the third week of February to completely wipe out. All right, remember, markets go down at a 4 or 5x rate compared to how they go up. Okay. So, I mean, you may have heard the term elevator down, stair steps up, that kind of thing. But you can see this candle here, it's clearly a hammer. So that would indicate that there was some buying here. Now, I will tell you, let me come into a 5-minute chart here. I'm going to show you something. You can see here, this just shows you how amazing this market was. Right here at 345, the market's moved from here to here about 135 points, roughly, give or take, in 15 minutes. Now, what was really happening there? It had nothing to do with the Fed. We had a little bit of a bud right here like this. We had a signal here as it started running. If you were day trading and you want to trade a 5-minute bar, that would have been a good entry signal. I'm not day trading this market, but 135 points in 15 minutes in the futures market is pretty good, but it's moving really fast. What happened here is every month in pension funds tend to rebalance their big portfolios. Let's say a pension fund, I'll keep it simple, they have a 60%, 40% ratio between bonds and equities, okay? So as equities fall, then what happens is the ratio probably becomes 65-35. So every month in, and they're not required to do it all in one day, but every month in, they come and they take a look at their ratios and they say, okay, we need to get back to our standard. That's part of our investment charter. So what does that mean? Well, we gotta sell the bonds right here, and we gotta buy the equities. And typically they don't do it during the day. They wait till the very end of the day, and then massive buy orders come in, and that's what happened right here. I mean, so on one respect, it's good. It moved the markets up a little bit and kind of dropped vol down. But on the other side, it did move up because buyers are now starting to come in and pick up stocks, because we were moving into the weekend, and there was a lot of fear as to, it seems like everything bad that happens over the weekend, with news coming out of China or Trump on a Sunday night. So markets were just geared up for a very wild and crazy Friday, and that's what we had. Okay. So this right here was more of a pension fund rebalancing kind of thing in the last 15 minutes. But if we come back in here and we take a look at the chart here, the other thing I wanted to show you, and let me just turn my pen off for a second. If we look at this, and let's go back to a daily chart, I'm going to come in here and I'm going to show you that from the peak up here that we hit on February 19th, and it hit the same peak again on the 20th, which is when the drop stopped, all the way down to the floor on Friday. The E-minis actually moved a range of 16.02%. So it was more than a correction. I mean, we were only 4 percentage points away from official bear market if it had closed down there, which is just truly amazing. In 6 trading days, that shows you the severity of this move. Now, if I come over and show you where we are now, where it closed, you can see here it closed here at 29.88. So right now, we're down 12.05%. In the interim, 6 days, the S&P moved down 544 points, 544.25 points. And now it's closed here. It moved up that 130 some odd points in the last 15 minutes. Otherwise, we were floating down around here, right? I mean, that's where we were until boom, up we went. And that is basically how the markets really played out this move. We're still in the red, obviously, across all indexes, but I want to just point this out. One other thing I want to show you. Let's come in here and let's take a look at the RSI. If we take a look at the RSI right here, you can see on this daily chart, we're down here. I mean, we reached a low of about 1911. That's below the 20, but let me show you how ugly it got. If I come in here and compare this to the big move lower in Q4 of 2018, you can see here that we're almost the same, right? I mean, if you look at that move right there and this move right here, they're almost identical. This might have been a 1 point lower, but you can see that it's just amazing, the sell-off here in this thing. So that is another sign that we had a very severe sell-off. Now, I do believe we're going to get some chop in here, and then we're probably going to come down and test this again. The odds favor us going even lower and then moving up and then testing maybe once or twice before we get through this thing. And that's what the charts are indicating. However, anything can come out with this virus. So if it looks, and the hard thing is trying to guesstimate the forward earnings for 2020. They were set to do very well until the production capacity of Japan, South Korea, and China, which controls just about all of manufacturing globally, is experiencing some severe reductions. So that's just something that we've got to keep in mind here. Okay, I mean, we've got to watch it very closely. Now, if we come down here and look at the volatility, because I wanted to show you that, let's look at the back month, which is the March and April futures contract. You can see here how deep we are, and this is a daily chart. You can see here how deep we are in the red. This shows we're in backwardation. This shows that the March futures is higher than the April futures, which means the skew is inverted. It should not be like this. And anything in the red here just shows that because the dividing line is 0, you want to be in the green for calm markets. We were actually in the green on the 21st of February, and then after that, the skew inverted, and it just went haywire from there. And if we look at the front month skew, now this one is 3.1. So the March volatility futures is 3.1 vol points higher than April. And then, of course, if we look at the front month skew, which is the current VIX against the March, look at this sucker, 14.01. That means the VIX is 14 points higher than the March futures. Now, March futures expires in about 3 weeks. These two have to be equal to each other, the March futures and VIX. So that means that the March futures is going to dramatically go up, or they're going to meet somewhere in the middle, which means we could see the VIX come back down over the next 3 weeks. I'll tell you, it's very difficult to keep the VIX elevated because as the markets move lower, the VIX can go up, and it went up this high because we moved so fast, fastest in history over 6 days into correction territory. But if the markets start to stabilize, even though we're down that far, you'll see the VIX start to come in rapidly. It's going to stay elevated, because the other thing that I wanted to show you here is just go look at the VIX itself. Um, I know you're on here. Here we go, right here. You can see the VIX itself. We hit a high on Friday of 49.48. Now notice I always, when I show these in my sessions, I always talk about the zones, right? The green, yellow, almost red, and then the rare zone of black, which I call black swan hedge, right? So in this particular case, you can see we're in zone 4. And it's just, I've got some other things on here for our members, but you can see over here that different option strategies mean different things depending on what zone that you're in. Right now, I just chose these zones arbitrarily, but just from doing this for a long time, they make a lot of sense and they tend to work out very well. So the other bit of news that I want to say is every time we get north of this level, we typically stay elevated before we move into the yellow again for at least 60 to 90 days. So we've got, at a minimum, because the market's going to be very fearful, but because this was a binary event, and if they get a good handle on a vaccine and they get a good handle on estimating future earnings impact, even if it's worse, then you're going to see the markets react to that and then adjust forward guidance numbers and valuations, PE ratios, and then things will settle in very quickly. And then we'll probably start another up move again. The longer this goes on where they can't do that, then I think the impact's going to be a lot worse. We could move into Q2, which means downstream into Q3, we can start to see more. We'll see again, even then, more impact. So volatility is going to be elevated. We had said, and I had said in 2020, expect more chop and higher volatility anyway. But of course, who the hell knew about the coronavirus? But this was certainly the catalyst that just moved things. Now, I wanted to show you something on the VIX here. Notice here, I'm going to go back. I'm going to leave it on the, I'm going to put it on the weekly chart. Okay, let's just go to the weekly here so we can go back in time. And I want to show you here. Let's just go back. I'm going to go back to times when volatility has been in this red zone here, and how long VIX can stay here, meaning it's closed in this area. So the VIX closed here. Here it went up there, but it never did close here. So let's just go back in time and take a look. So as you can see, the last time we were up in this zone here, in the red zone, right? Or actually, we moved into the, well, let's just look at the red zone for now. If you look at the red zone, the last time we closed in that area was right here in 2011. All right, and we had a major problem in 2011 in the markets. And you can see right here that the length, and these are weekly bars, by the way. All right, let me just zoom out just a little bit so you can see a little bit better. You can see we were up here in this area for over 8 weeks. That's 2 months, over 31. South of 50, but over between 30 and 50. We were kind of in this middle no man's land around 35, 37 area. We would come down and then we'd go back up. We'd come down, we'd go back up. You can see these hairs on these candles here. We were trying to come up and come down. So there was a lot of machinations going on yet. So once we get up in this area, you can see that, but even staying elevated north of 20 is a long time, right? I mean, in this particular case, and this was not the financial crisis. It was from August of 2011 until we finally got into the green. It was in December. So you're looking at August, September, October, November, December. So you're looking at 5 months before it finally worked things through. So I can promise you, with a higher probability, that we're going to expect elevated vol at least for the next 2 or 3 months. All right, you can expect that. Now if we go forward here, you can see the last time that this happened was the SARS epidemic. So let's just go look at 2003. And if we look at this right here, this was the SARS epidemic right here. And you can, or no, not here, where are we? Let's go to 2003. I wanted to show that. Let's just come back here. Okay, so here's with SARS right here. You can see in the SARS epidemic in 2003 or 2002, 2003, we were up here for about 4 weeks. And the high point with the SARS was at 48.46. Okay, remember, our VIX closed, or it reached a high point of about 49.5. So almost to the T. same place. Now let's go look at the financial crisis, which was in 2008. Here in the financial crisis, we were up here, so it's completely different. We were in the financial crisis of 2008. We were up here for 6 months. Remember, this is a weekly chart, and we reached a high of 96.4. So it was a different kind of scenario. Back then, we didn't know if the banks would even survive, if they'd even have a banking system. So, and you could see that, I mean, the minute we broached that 50 level in the VIX, by the time we got back down in a more normalized mode, we broke it on October October 6th, right, of 2008. And when we finally got down here, we had a few dips, but when we finally got a little bit lower, it was in December of 2009. So you're looking at what, 14 months of elevated volatility. So that just shows you that we can get up here and stay up here. And this is in the black area, which I call the black swan. So we haven't really had one of those. I will point out that in uh, what we had here in 2015, we actually moved up to a high of 53.29, but you could see how it was an intraday kind of move. And then if we look at Volmageddon, which happened in early January right here, we moved up to 50.3. You can see up here, that was when there were a lot of hedge funds short volatility. They got caught short. And then XIV, for those of you that the trading XIV got cratered. It went out of business the next day. So that's kind of where we're sitting right now in this one. So we can expect a lot more sensitivity to news, a lot more chop. And Monday or Tuesday, it'll give us a good sign. Now, what am I going to be looking for in the markets here? I'm going to be watching, if I just come back to the E-minis here real quick and take a look at this, and let's just spread it out. I'm going to be looking for this low that we hit. Let's go back to it daily right here. This is the 2020 low right here, 28.53. So I'm going to be watching that level to see if it's broached. The other thing that is going to be, excuse me, I think let me just check one thing here on my screen. Sorry, I was getting an error message here. I didn't know if my screen was going to shut down or not. One thing we got to watch for here, typically when you have a sell-off like this, it's attracted like flies. This is a 200 EMA or SMA right here. Excuse me, I had to sneeze. I'm just sneezing like crazy here. So I can see the markets coming up and testing this. This is at 30.49 roughly. Now I'm coughing. So you can see the markets testing this area and then coming back down again. Okay. Man, I can't get rid of the sneezes. So a little bit of a move here and then come back down. Let's test this area here. So I think we're going to have a 200 EMA, or this is an SMA, I'm sorry, instead of an EMA. It's one more of the black boxes follow. So you're going to see the 200 SMA challenge. That's going to be one of the black box algo driven checkpoints. And then you got to see the lows. Test it again. No, I ain't got the coronavirus. I've been coughing for years. I would have been dead a long time ago. So anyway, that's kind of what I'm looking at on this chart. So I showed you volatility and some of the things it can do there. Let's take a look at interest rates. If we look at the 10-year, look at this, guys. We are down at 2020 lows. Let me just move this down here so I incorporate the 2020 low at 1.127. Okay. Now, as the market started moving higher into close, you can see interest rates closed on the low. I mean, they literally closed on the low. So even though the markets moved up 131 points after Powell's statement, I mean, after the pension fund rebalancing, Powell's statement did nothing. He came out in the afternoon. This was starting at 1 o'clock. And as he made a statement, interest rates just kept rolling over. He's going to have to do something here. But you can see this 3-4-5 pattern. So I would expect a little bit of a bounce tomorrow in interest rates. That would be a good thing, I believe. So that's a little bit about where I'm seeing the interest rates right now. And then let's look at bonds. They were up 2.2 handles. I mean, the bonds are just, this is a 5 minute. Let's go to the daily chart, get it back. You can see here bonds actually took out, let's just get it down here like this. You can see the prior all-time highs. Let me put it on a weekly chart so it doesn't get too condensed for you guys. All right. Not quite the all-time highs. The all-time highs were right up here in the bond market. Okay, and this was back over in 2016, 2015, 2016 when we had major problems with China as they're devaluing the yuan and things like that. And you can see here with this move, let me just get that off the screen. You can see here that we've now moved up to a new 2020 high right in that area right there. So, I mean, we hit 170. Actually, let me just get this a little bit better set for you guys right here. So we hit 170. 28. Huge move. Bonds are going to have a hard time holding this. If the Feds come in and they start buying or they start doing QE, I don't think they're going to be buying on the back end of the curve. I think they're going to be buying on the front end of the curve. But it's hard to tell just what they're going to do. But the bond market is going to be having a hard time holding this level like this. You can see here it's set up for a divergence, which suggests bonds are going to come down. The back end of the yield curve is going to go up. If we look at a little bit closer to the front end, if we look at the 10-year interest rates, I mean, look at these guys. 1.127. And if I go in and look at the I think I showed you that one, but if we look at the 10-year futures, you can see here we already took out this high right here, okay? And if I go back to the same time, back in 2016, the 10-year, we're not quite there yet. It wasn't as high as the bonds, but we're pretty darn close. And it's also setting up for a divergence. So that would suggest to me that, you know, playing bonds to the downside next week could be an interesting proposition. Now, another way to play it, an easier way to play it, is just going to TLT. All right, let me just get that off the screen. So if you look at TLT, and we just put this high in right here like this, and compare where TLT has been before on a weekly chart like this, you'll see here that it's never been this high before, even though it follows bonds. And the reason why it's got a little bit of a positive roll yield, the way the fund managers calculate TLT. But I can tell you that the odds favor a little bit of a pullback. Even on this weekly chart, we're getting a divergence. And if I look on a daily chart, you're gonna see the same divergence. Well, not really. So on this daily chart, it suggests that if we do get a pullback, then it's going to go higher. So that's a good classic example of just kind of using some of the fractal nature in the markets. If you look at it, the weekly is saying it's going to go down, but the daily is saying if it does go down, it's going to be bought and driven back up again. Okay, so just keep that in the back of your mind, which goes in with my thesis that the markets could bounce up a little bit and then roll back over. So we just need to follow that really closely. Okay. And of course, if we look at currencies, you know, the dollar is king, but you can see here the dollar wasn't king this last week. It's a daily chart, so it's been selling off along with everybody else. And, you know, in times of safety, generally you see money kind of flow into the dollar, but here the dollar got so extended that it just gave it up. Now we're still in this regression channel in the upsloping line here. I think it's going to bottom and start to move up a little bit, but you can see what happened. And then of course, when the dollar suffers, the euro loves it. So you can see the euro bouncing hard, and all the euro is doing is just bouncing off completely oversold levels, coming back to the middle of this regression channel, right up in this area here, or the 50 EMA. Then I think it's going to roll right back over again, and then the dollar is going to go up. So I would think over the next couple of weeks, being long dollar euro would make sense, or being short euro or something like that. That would make sense to me. And then if we look at the Japanese yen on here, which I also find interesting, notice here we did see a money flow into the yen here over the past 6 trading days. it's kind of resumed its role as a safe haven for money, more so than others. So we've had a strength in the yen, we had strength in the euro, which that's about 70% of the value of the dollar index. So that's why the dollar index rolled over. Okay. And then, of course, if we look at gold, well, I told you guys before, gold is one of these things where we hit my target, we moved up, and now once you've hit this target, there is no divergence here. So it does tend to suggest we're going to come down and find support. You can see support at a prior price level as well as the 50 EMA right here. It just bounced right in this area here. Um, and we could come down to a 2020 low, which is still relatively high off the prior levels for gold. But I think it's going to chop around here because what happens with gold, you'd think it's a fear trade, but when margin calls are being demanded, when everything is needed, people are going to sell everything, throw the baby out with the bathwater to make things happen. And that's what happens with gold. But gold loves low interest rates and a weaker dollar. But this was a case where that correlation didn't work just because of the flummox of the market. Okay. The other one that I've kind of talked to our members about is palladium. You can see with palladium here, we did not have a divergence, even though we went higher. So to me, it was not a sell signal, even though we fell a good bit. It's $100 a point, guys. The last sell signal we had in palladium, some of our members took and made a lot of money on it. But we just didn't get the signal. I saw that we moved up higher. I was hoping that on this second leg move up here, we get a divergence, and we didn't. So there's a no call signal. But eventually, this thing's going to give it up. And it's just going to come down hard. So I just don't know when that's going to be. We may not get the signal. We may miss it. Oh, well. But that's kind of what I'm looking at there. And let's look at copper. Copper suffers when China suffers. So we're coming back down here. Ideally, I'd love to see it take out this low, give us a bullish divergence here, and that would be a perfect entry for a long. And for those of you that follow along, I think I offered this on a weekly update. We're getting down to that level here where picking up FCX would make sense. Freeport McMoran, okay? Now, we don't, if this thing drives up hard, then we'll get a small divergence right here, similar to what we had here. But when you're around the 9.6 area, it's cheap. You can buy a couple hundred shares and then pick up more if it comes down much lower, but it follows copper. And the minute they get a vaccine announced, and the minute China's President Xi comes out and says our factories are 100% back in full working order, and they're going to fudge the numbers for Q1 GDP anyway. I don't know what they're going to be. They're going to be worse. The market's already expecting it, but they're going to fudge them. They always do. I don't trust their numbers. But either way, that's probably going to put some lift in copper, which means lift in this stock right here. So just kind of keep that in the back of your mind. Of course, if we look at oil right here, I mean, OPEC's another one that's suffering with the coronavirus. All those factories being shut down, logistics companies aren't using oil and energy, as that it just really drove oil down here. Now, if we get a bounce here, this I think would be my target was actually around 47.90. We blew right through the target. I mean, who knew, right? I put this on here back over here in beginning of February, but now it's painted a lower Elliott Wave 3, which suggests any rise up here is going to roll back over again. But let's see what it does. But a small option contract in the futures market in oil, if you get the signal, could make some sense, right? I mean, you could come in here to the 240-minute chart, and you can see on here, there is no divergences at all. And you can see each 240-minute bar is just massive selling. It just does not stop. And then on Friday, starting around noontime, going into close, there was a little bit of selling on news that OPEC may meet. They're going to meet in March 6th and 7th, I think, in Vienna, their favorite spot, and try and come up with a way to do some temporary production cuts. That may be good for $1 or $2, but I think it's going to run up. Here's the resistance point up here around 47.90, 47.80 area right there. Call it 48. Then I think it'll roll back over again. But, just doing a short-term trade makes some sense to me in that one as well. Okay. All right, everybody, that's kind of where we're sitting. Really wild and crazy week. Just as a reminder for our members, we've got a weekly market watch tomorrow evening. If you're not a member, I highly encourage you to come in. We're tracking these markets and following them very closely. So you guys ought to come on in and join us. Otherwise, have a great weekend. And just remember, the first big bounce up, don't be so willing to go all in longer term. Just expect it to roll back over again. Probably the 200 moving average would be maybe the first choice of a hit. And then after that, just watch and see how the algos pop in and if it starts selling or not. Okay. All right, everybody. Have a great weekend. Stay safe out there. And members, I'll see you this Sunday night. Ciao, everybody.